Based on the latest Fed commentary, a third quarter rates lift-off is a possibility, but the market consensus is looking at the fourth quarter. Why is there a growing disconnect? Let's find out more and get some market implications from Jason Ambrose of Vanda Securities and Paul Hodes of Citibank. Gentlemen, welcome. And Jason, you're a guest host today, so let's kick it off with you. Why is there this growing gulf between what the central bank is telling us and the investment community is thinking?
Well, I think with the central banks, Chloe, the Fed is ultimately hedged, and far more so than any other central bank probably in history. So whereas they used to have a very strict mandate, which was unemployment rate and PCE inflation, now what you get is all these external factors that they now say are in their equation to when they want to move rates. So what that is that's fairly complicated for markets to try and unravel what that means, because all of a sudden we have international affairs thrown into the mix, or we have, I think the most recent one was the strength in the US dollar. So it used to be an equation to when Fed would lift off. That's not so easy anymore. So it's trying to, what the market's trying to do is trying to get to that point where it can actually work out what's the strongest of the probabilities.
Right. So Paul, from where you sit on the retail side and from wealth management, has what Janet Yellen said altered your views, or at least prompted you to reposition your portfolios?
Well, you know, the feedback that we've gotten and our house view really still says that we're seeing a rate hike in the U.S. at the end of the year. So it really didn't change from what Yellen's announcements were. We still think for our clients the best thing to do is have a balanced portfolio and move out of over-concentrations in fixed income and rebalance into equities. We still think very strong on the U.S. side, on Europe, Asia, especially China.
So is it because doves are flying high, therefore a lot of risk is going into whatever asset classes that you're looking into?
Well, the macroeconomics are strong, and fundamentally the shift in oil prices of dropping more than 50% since last summer really has significant impacts globally, and investors can benefit from it. But to your point, we do see an increase in volatility. We've already seen it so far this year. We see that continuing. So there's no straight lines in this investment business. And so clients really need to make sure that they're diversifying and really diversifying out some of that risk.
And so from where you sit, where you look at market positioning, do you see a lot more risk going into different asset classes?
Well, I think what you saw, and I think we mentioned earlier on the recent comments from Yellen, and what we saw is probabilities of the first rate hike being shifted out, and as you quite rightly mentioned, that's dovishness. I think what's moving those probabilities is futures prices, and what's moving futures prices is the interesting part is traders. So you're kind of getting this environment where it's not the economy that's actually dictating where the first rate hike is going to be. It's positioning. It's how traders see where the first rate hike is going to be. And that's quite important, because when we look at the Fed are very, as I say, they're very hedged, and they're very, very cognizant of what the market expectations are. They're not unaware to where Fed fund futures prices are.
How much did they have 1937, at least the lessons of 1937 in mind, do you think?
I don't think they've really got that in mind at all at this point. I think, look, I think in the previous era, I should say, I think Bernanke certainly had that in mind, and certainly his CV was kind of tailored for that. But I think the new Fed is very sophisticated, and it's very market savvy. And I think that's a transition from the previous Fed, and I think that's a really interesting